Hey everyone, and welcome to another podcast with Kristen Ambos of Always On Point. Today I am sitting with Randy Foss from MGIC, who many of you probably don't know what that company is. However, you understand the terminology of PMI, or private mortgage insurance. So MGIC was one of the founding.
It was the founding.
It was
yes.
the founding
Yep.
private mortgage insurance
Correct.
company.
Back in 1957.
All right. So with further ado, Randy Foss, thank you so much for being here.
Well, thank you for inviting me to the couch.
Yes, you're
that's for sure.
welcome.
No problem at all.
It's a very fun place to be. We're getting everything rolling on mortgages, making them as interesting to understand as possible.
Sure. It can get complicated, but it
clear
is
as
pretty
mud.
easy. Yeah.
Right.
Right. It's clear as mud.
So,
That's true.
But hopefully you can clear up the PMI thing. We were just kind of talking before this.
Mm-hmm.
I still have so many clients who my parents told me never to pay PMI, or I don't want to pay PMI. That's horrible, or it's so expensive. Why do I have to pay that? Or I have really great credit. Why do I have great credit and I still have to pay for it? And so today, Randy and I are kind of want to break the myths for you. What truly is PMI? What's the use of it, and how it can really help you with your wealth building strategies when it comes to home ownership. So, Randy,
Definitely.
tell us about yourself and how long you've been with an account manager with MGIC.
Yeah,
and PMI in general.
I've been an account manager with MJC for going on 5 years.
Yep.
Started in February of 2020. Prior to that, I was a mortgage lender for a little over 20 years.
Yep.
And
So you know all the sides, all the things.
I know all the things now, exactly, yes. And I cover the state of Wisconsin and then Northern Illinois.
Okay.
Is my territory.
Yep.
So a lot more windshield time than what I had as a loan officer.
Sure.
But, yeah.
Will happen.
Yeah, definitely.
And in true transparency, I do use MGIC as one of my PMI companies, and probably one of my more favorable ones. But
Appreciate that.
because they are so strong in what they do, and Randy is such a plethora of knowledge that when I call him or ask him anything, he's right there so that I can reiterate it to my clients and things like that. So it does take a team effort to still do this. So just so that the audience knows that we do have a little bit of history when it comes to
Right.
working together in this and things like that. So.
That's true. It's very nice to say. And I have to owe it to my team as well. Our home office is based out of Milwaukee, Wisconsin,
Yes.
where the company was founded back in, like I said before, 1957. So we've been doing this a while.
Yes.
And it's definitely got a team of service and backroom people that definitely help me on the front end. So
Yeah.
that's great.
I love it. I think it's awesome. So going off of that, I love that it's based out of Milwaukee and
Sure.
that it was originated there. That just shows you how hometown and we have big companies like this in the state of Wisconsin all over.
It's true.
So that's pretty neat there. What would you say to the consumer or even a real estate agent who maybe is trying to learn more about PMI for their clients? What's the number one thing PMI does for a consumer?
It's a great, like you'd said before, wealth building tool.
Yep.
Where, you don't have to put the 20% down that individuals are looking for right now.
Yep.
Agency guidelines, Fannie, Freddie,
Yep.
are going to say that if you don't put 20% down, you're going to need to carry some sort of private mortgage insurance
Yes.
on there. So it definitely does help keep money in your pocketbook.
Yep.
And leave it there so that you can use it for other things. And that
Yeah.
other things can be a multitude. You can use it for whatever you want to while paying a smaller portion to us. So that'd be, $30, $50, sometimes $100, depending on the loan size.
Yep.
But it definitely is a benefit that way, for sure, to wealth build.
Absolutely. And so with wealth building, if let's say instead of putting 20% down, and let's just use easy numbers for the audience. I have $100,000 purchase price.
Okay.
And instead of putting 20% down or $20,000, I might be able to put 0 to 3% down.
Right.
And your company is going to ensure that I make that payment on time.
Right, exactly. So the insurance piece actually benefits more for the financial backing.
Yep.
It benefits the lender.
Yep.
So that they know that they're going to be made whole at the end of it in case there's a foreclosure or missed payment scenarios that would be out there.
Right. And the reality is that the less money you put down to an agency like Fannie or Freddie, to a loan officer who's writing on behalf of those agencies, it's a higher risk, right? You're not putting as much down, so there's a little bit of a higher risk there. And so what the PMI, the private mortgage insurance, does is it actually ensures the lender or the agency, like myself or Fannie Mae and Freddie Mac, that you're going to continue to make those payments. So that's the insurability, is that that's going to happen. That protects us. And now we want to lend to you. If that insurance protection wasn't there, a lender or the agencies, Fannie and Freddie, would probably say, now you're required to have 20% down.
Correct. Yeah, that's where the risk factor becomes the, on the agency side of it itself.
Correct. So PMI actually gives us the ability to put less money down.
Correct.
So it's working in favor of us. It's yes, you're going to pay us a little bit, but we're going to root you on in order to buy a house now, instead of having to wait, however many years to build up that $20,000 or that 20% down.
Right. I think that piece becomes more of a moving target, because obviously as values increase, we're looking at, on average, maybe 6%. I don't know what it is in the exact market that we're in, but that appreciation factor goes in, which then means next year your 20% number also went up, by that 6 to possibly 9%, whatever it might be.
Yeah.
So, yeah.
And how long does one have to pay private mortgage insurance for?
There's not really, there's somewhat of a standard that's out there. I would say 4 to 5 years.
Okay.
But really when your value gets to 78%, and that's on a normal amortization type schedule. So that's just making your monthly payment piece.
Okay.
If you're going to use a new value or a new appraised value side of it, then that date timeline can change.
Sure.
Obviously putting more of a larger pot down would obviously help as well.
Yep.
But really getting to those 2 percentage marks really makes a bigger difference.
Yeah. And here's the other piece that I think people don't realize. It's kind of the game we can play, if you will, is if you're working with a lender who truly understands the importance of PMI and how it can help you, the lender will most likely also understand that maybe if you put 15% down instead of 20, you get a lower interest rate, because the lender's saying, you're going to allow us to be insured, that you're going to make the payment. So we're insured to make sure. Right. That's my terrible English, but I feel like that's right.
Correct.
But as a lender, I'm insured that I'm going to get my money regardless.
Right.
So as a buyer, I'm going to say, if you allow me to take that insurance, I'll give you a benefit of a slightly lower interest rate. So for a really interest rate savvy people, PMI can actually help you achieve a lower rate in some cases. Not every case, but in some cases. So I want you to know that as the consumer, as the realtor looking in, that this is where it can be a really big benefit as well.
Right.
And build your wealth, because then maybe you pay a couple of years of PMI. And I've done the math, so I'll just bounce it if you don't mind.
Go ahead.
Maybe it cost you $2,500 in those 2 years of PMI, because PMI at that point can be as little as $20, $25 a month.
Correct.
It doesn't take much. So maybe you're only spending, a couple $1,000s in PMI, but you're actually keeping then that let's just go off the $100,000, and you put $15,000 down instead of 20. Maybe you spent 2, but you kept 5 in your pocket.
Right.
You made money on that interest, and you're still accumulating your equity, as well as now for the remainder of the 28 years of the loan, you have an 1/8 lower interest rate.
That's correct. Yeah.
I'm willing to bet that that's probably at least another $10,000 to $20,000.
Correct. Yeah.
So now, not only did you keep money in your pocket, I hope everybody's following me here on this.
Right.
That's where you can maximize your use of PMI, and you're okay. The PMI companies are okay being used like that.
Sure, of course. Yeah. We'll cover you as long as we need to.
Yeah, right.
And that's it. But the moment that you tell us that it's met those requirements, then we can bow out.
Yeah.
Which is also, I think, a very big benefit to it as well, is that it actually does go away.
It goes away.
So it goes away automatically. Again, like I said, once you reach that 78%, it falls off automatically based off of the Homeowners Protection Act.
Right.
So that piece of it makes it, all the much better.
Relearned a ton of that in my continuing ed.
Did you?
That I just did. Sure. I did about 15 hours of continuing education, and every state requires you to know about the Home Protection Act. So big act for those of you that don't know. So you brought it up. And these protections are put into place where it's not... PMI is not out to be like, oh, we're going to sick it to the consumer.
Correct.
We're going to take all their money. It's put into place to help protect the financial markets, especially, in this case, only the home financial market. But it's put into place to protect the consumer, but protect the lenders, so we don't have all the highs and the lows of foreclosures and non-foreclosures, because bad things happen to good people.
Right.
And it doesn't always mean that the person who's foreclosing because they're just lazy and don't pay their bills. Things happen to people all the time, medical things,
right.
divorces, loss of life. It doesn't matter, that can happen. And so that protects those of us who are either the ones who are contributing the money or the ones borrowing the money, that we can still walk away essentially free and clear.
Right.
So it's a huge protection. And I'm reiterating that over and over again because I feel like people don't understand that that's a protection against, not against, but for all of us instead of against us.
I like the word protection, but I also like the word partnership.
Yeah.
So you're buying a home and you didn't have the dollar to put down. So we're going to partner with you to make sure that you can get into that home sooner.
I love that.
I think that's a bigger,
because that's exactly what you guys do is you partner with people.
Exactly.
To say, we'll pick up the insurance and know that you're going to make the payment.
We'll cover our share.
Yep. That's amazing.
Yeah.
And it is crazy. So many times I hear from clients being like, oh, that's all the PMI is? Like, what? I want to know what the monthly payment of my PMI is. It's $45. It's $35.
Right.
That's it. I hear that's it so often because people have it in their heads that it's going to be $200, $300, $400 a month.
Right.
Don't get me wrong. There's scenarios that it can go up that high because maybe you have a higher loan amount and a lower credit score. You're a higher risk.
Correct.
So it's going to charge a little bit more. It's also why it's maybe cheaper to insure a condo than it is a $1 million property, right? It's all the insurability.
Yep.
And so those do, reflect person to person. But with that still being said, it's not as expensive as you probably think PMI is. And it's not as horrible as you think it is.
Yeah, the mortgage insurance actually, if you looked at the last 5 years, is the major piece that has actually gone down in cost over the course of time. Obviously, appreciation values have gone up. Closing cost dollar amounts, they're somewhat controllable, but they're uncontrollable at that point, with different factors that go in. Credit reporting fees being a big change recently.
Over 300% higher than they were last year.
Yeah.
And another hike on them now.
Yeah.
So you're right on the money when you're saying right now.
Right. And the mortgage insurance side of it over that course of time has gone down.
Yes.
And when I got into
I'll vouch for that, by the way. Seeing those numbers keep going down and down.
Yeah. When I got into the industry as a loan officer, we had things that were rate cards. If you remember the rate card,
the rate card.
Rate cards I was looking at yesterday and the numbers were just much higher than what they are right now as far as that's concerned. And now we've gone into what's called a risk-based pricing, which is getting a little bit into the weeds.
It is.
But at the same time, we're talking, like you mentioned, credit score, loan to value, debt to income ratio. Those are factors that go into it now that we can really fine tune how much cheaper we can make that payment for you.
Right. And to the consumer out there, what he's saying too is, and what we were just kind of going over as an example is you can buy a $500,000 home with a 620 credit score and 5% down, 10% down if you really want to.
Right.
The price you're going to pay for that is a higher PMI.
Sure.
Your risk factor is a little bit higher. But again, that's a choice you can make. You can also say no. And as a lender, I can work with you on your credit. We can work to get your credit score up, and now your PMI can be lower. It's a choice. You can take it now or take it later.
Correct.
And even if you get into it now and we refinance, let's say you put 5% down and we refinance and you got, 5 or 6% appreciation on top of what you put down. And maybe you're closer to 10% equity now, but we refinance you to a lower interest rate. We'll also rewrite the PMI at that time.
Correct.
And if your score is higher, your PMI can get down. So again, PMI does not just stay the certain amount for the life of the loan. We can rewrite that PMI when we rewrite the loan to bring down the overall interest rate as well.
Correct. Yeah.
So they can all work in your favor. Some of it can just be a very short term factor if you need it to be, to make it better later on, maybe a year or 2 years.
That's correct. Yeah. And I think you also forget the portion of making that amortization payment down. So obviously you're paying a payment down. So you had mentioned putting 5% down initially, the appreciation factor, maybe you're at 10%, but you've also paid 2 or 3% down in just monthly payment balance. So that obviously brings you to maybe 15% down, which is kind of that sweet spot where it becomes very cheap to have mortgage insurance.
Correct. And again, using that mortgage insurance insurance to maximize your wealth without taking all the money out of your pocket where you
Correct.
could invest it other places.
Correct.
Diversify what that is. I've had so many people and that will say, okay, hold on a minute. I can take, and it doesn't even matter. We're talking really high credit score, wealthy people
Sure.
who are saying, okay, even if I take 6% interest rate at 10 or 15% down, I can make more money doing this and take the PMI here. They're using it again to accelerate their position financially.
Correct.
And so you can have, and it's okay, your lender is working on behalf of you. Remember that. They can rework all of these numbers for you so that you can make an educated decision, as they should be. They shouldn't just be telling you what they think. They should be going through that. And, shameless plug here for MGIC, I can shop about 6 or 7 different PMI companies, and they're coming in at the top on almost every occasion.
Wonderful.
And then with your partnership, and he means that to both his lenders and the consumer, we really do a lot of great stuff together.
Yeah.
And it helps me being able to have somebody like you on that side.
Sure.
Where we get we get it all the way around, because PMI is also underwritten, right?
Correct.
So if PMI is an underwriting question, I can go to you, I can talk to the clients. It's not just a mask where, nope, we're not doing it.
Right.
It's let's talk about it on a case by case basis, because again, bad things happen to good people. And what they're saying right now is their situation may not have been their whole situation in the last 10 years and won't be going forward.
Correct.
So there's ways we can work with you on that to put you in a situation that helps you grow back to where you once were over time, using that housing as an option.
Yep, that's true. I mean, obviously putting that less dollar amount down does, in fact, like we mentioned earlier, have that asset piece that you can keep it in your account, which obviously is another underwriting factor.
Correct.
That they'll look at, saying, hey, they've got some reserve funds that they can utilize where mortgage insurance is taking the place of that. So it's
and a big piece, I think you'll agree with me here, hopefully you do now that I just said that, is taking, maybe you sell your house right now and you're like, I don't want to go back into PMI, but hopefully we're giving you an expression in your mind to think about it and go, well, wait a minute. PMI is really not that bad. Maybe I pay off all this higher end debt with the proceeds of my house and only put 5% down because PMI really isn't as high as I thought it was. And now I'm not paying high interest and I have a low PMI payment. So overall, my financial well-being is better doing that by utilizing PMI to my favor.
Correct. It also allows you to possibly purchase a larger property as well.
Correct.
Because you're using maybe your funds to be able to buy a higher property.
Yep.
So that percentage number does go up. But mortgage insurance comes in to play its part.
Yep. Absolutely. Because as a lender, we're really pre-approving you on a loan amount. We're not pre-approving you on a purchase price.
Right.
That's kind of a big myth, is people are like, well, I can go. No, it depends on what the taxes are. Taxes are different everywhere. We're pre-approving you on a loan amount. So let's say you think, oh, on this $100,000 house, and you set up with that 20%. And now we're using all of your funds. But maybe now you're like, well, wait a minute. If I can get PMI and I don't need 20% down, maybe I can go to $150,000 and only put X amount down.
Sure.
Right?
Yeah. Yeah.
Or maybe I can afford to now look at 110,000 versus 100,000. I know these are just numbers we're playing around with, but the reality is that maybe you can use that same $20,000 to buy a higher house.
Correct.
And use PMI and get more of what you need.
Right. I've used the number, I mean, just over presentations and such, 15,000. Yep. It's a pretty substantial number for most people. 15,000 at 20% is a $75,000 house. Yep. At 10%, it's $150,000, and at 5%, it's a $300,000 house. You can see the magnitude that the $75,000 to $300,000 is huge as far as what you can afford.
And now this is only on looking at what you have down. So my mind is blown.
Okay.
Not really, because I do this for a living, but I'm picturing if I was a consumer listening to this right now as I'm driving down the road.
Sure.
My mind is like the emoji with the brains blowing up.
Yes.
Repeat what you just said, because I really need the consumer to hear that.
Of course. Yeah. So on a traditional loan, if we're not using mortgage insurance, $15,000 will get you a $75,000 purchase price.
Correct.
Right? Putting your 20 down. If you minimize that to 10% down, you're at $150,000.
Same 15,000.
Same $15,000. Now take that same $15,000 and put 5% down. $15,000 at 5% would be a $300,000 house. Substantial difference in a house that's $75,000 as opposed to something that's looking at $300,000.
Correct. And all stretches of the imagination.
Yes, all stretches of it, exactly, with the same $15,000.
The same $15,000.
Yeah.
So why I love that you just really dove into that is because so many people think they're locked in a box where they can't go over this amount.
Sure.
But yes, you can.
Right.
You got to be flexible. But again, working with a mortgage insurance company and a lender together to really give you your options and educate you on that is huge.
Correct.
Absolutely huge, because you as the consumer, there's not a class that teaches you about how to use your $15,000 the best way possible.
Right.
So you might go into this and the lender might say, yeah, you qualify for this. That's fine. And now you're thinking to yourself, if my lender would have done their job and let me know that I could have went up to this amount with the same 15,000, if I would have taken PMI versus not, I may not have to move again.
True. Yeah. Yeah. And you can afford to buy a bigger home with more bedrooms, with whatever.
Your family can grow within the same roof instead of having to, upsize and those types of things. So it really is a big factor into what you're looking for. And that's why I know PMI as well as mortgages are not the sexiest thing in the world to talk about for, 20 minutes to a half hour, yet so important that the consumer understands how to utilize these tools. And so bringing a new light to them was really, really important to me, because so many times PMI is misunderstood or overlooked.
Right. I think another big piece to it is, and obviously that's why they'd want to work with you as well, is because you understand the different products that are out there for PMI. So there's obviously the monthly, which is the most popular. But then you can probably see where I'm going with this, that there's also a single premium. That's
where you can pay it up front.
Pay it one time, and you will not have a monthly payment.
No monthly PMI. There's also one, sorry to cut you off.
Go ahead, you're good.
Because the consumer so many times is like, well, I only put 5% down and I never paid private mortgage insurance. The likelihood of you paying private mortgage insurance was huge. It was called lender paid private mortgage insurance, which just increased the interest rate to no monthly insurance is typically how that works.
That's correct. Yeah.
And there are times when that product is hot. And so that's even an option too, where no, it's not in your monthly payment. Maybe it makes more sense for you to pay a little bit of a higher interest rate than it is to pay the PMI. Maybe it's a little bit smarter for you to, instead of taking that 15% down and paying a small monthly PMI to get a lower interest rate, you exchange it and you pay a little bit of the higher interest rate or the same interest rate you would have at 20% down. You have no monthly PMI, and now you just have that extra 5,000 or 5% in your pocket.
Correct as well. Yeah.
Options upon options upon options. So we're talking flexibility here.
That is true. Yeah. And obviously understanding that part of it is the big piece as to why they'd want to work with you as their lender, to understand. There's somebody that understands how that part of it works on the go, right from go. You can speak to it. So
now in your world, real quickly, before we have to wrap up here, is a seller concession allowed to pay a single pay premium?
Yes, and a borrower's paid side of it. It's still a fee that's out there, but you can definitely have the seller concessions pay for that closing cost side. That also gets to another portion, which is the third and probably final product that we offer, which is more of a split premium. MGIC calls it our choice monthly.
Okay.
So you've got closing cost credits that, because it's point and you guys don't have large fees for your closing cost sides, you've negotiated a larger closing cost amount.
Yes.
Where you've got some excess. You can give us that portion of excess. We'll pay that up front, and then you'll still have just a smaller monthly premium payment.
Bringing that monthly down.
Bringing the monthly down as well.
Which in that case might bring your debt to income ratio down.
Exactly.
Which may also be a compensating factor to help you qualify.
Right. Correct.
Well, I hope we left all the consumers with their minds spinning.
I'm sure.
It was it was by design.
Yeah.
It was to get them thinking about all the things you can do with private mortgage insurance. So I am so grateful that you were here today.
Oh, no problem.
Thank you so much for just all of the info. I have a feeling we'll be back because there's going to be more
questions.
There's going to be questions. And I want to bring that to you guys. If you have questions on that, reach out because we want to bring you all the information back. And I can definitely talk to Randy, get those questions answered for you, whether they be now, in the future. Just know that this isn't a one and done podcast.
Right.
You can give us those questions. We will research them, get them back to you. It's part of what we do to help educate the consumer as well as the real estate agents and maybe even some other lenders out there on what they should truly know to help their consumer.
It's very true.
Yeah. There's a couple lenders listening. They got to know what's going on.
Of course they do. Yes.
I love that. No, we welcome everybody. Again, Randy, thank you so much.
You're welcome.
Can't thank you enough for being here and taking the time to do this because it is a really important topic.
No problem at all.
Awesome.
The couch was comfy. It made
good.
sense. Thank you.
Good. And for those of you out there who are listening today, we thank you for joining us. Continue to like, subscribe. And again, if you know of somebody who's interested in buying, this podcast might be one they really need to hear, share it with them. And our contact information will be below for you so that you know how to give us a call, give us a text, email, so that we may answer those future questions for you. Thank you again. We'll see you on the next Always On Point podcast with Kristen Ambos.